In this week's video, we'll cover several rare stock market signals that were recently flashed that tell us any weakness should be followed by higher highs. We'll be moving quickly, so feel free to use the pause button on your video player. It's a chart of the NYSE Composite as of the close on Friday, August 4th. We will cover this chart in much more detail later in the video. That commentary was recorded on Thursday evening. Since the look of this chart and the messages from the chart have not changed in any material manner, 100% of that commentary still applies, including that the market may be giving us an opportunity to invest new capital at more advantageous risk-reward levels from a short-term perspective. In the financial markets, we have two choices. We can focus on worrying about things that might happen, or we can meticulously pay attention to what is actually happening. There's a big difference. In this segment of the video, we'll be reviewing observable changes that we can see, measure, and put in a model. Monthly vortex indicator, lower portion of your screen here. We can see this. We recently had a bullish cross, green above red, after having a bearish cross in place for at least 6 months. We wondered, how many times has something similar happened in the past 75 years? Answer, only 11 times. And how did the stock market perform walking forward? The answer is quite well. 11 cases, every single case higher 1 year later, median gain just under 12%. 2 years later, every single case higher, median gain just over 16%. Still looks good. 3 years out, over 80% of the cases were higher than median gain, just a hair under 25%, allowing us to ask the logical question. Something that just happened that we can see, measure, and put in a model. Does it align with or contradict the secular trend thesis? Now we're looking at an indicator that we've covered many times in these videos, Williams percent R. It's a measure of momentum. Similar situation. This is a rare oversold look here in October of 2022. And then momentum shoots back up relatively quickly in the lower right-hand corner of your screen into a much more confident area. Going all the way back to 1940, it's only happened a handful of times, or more specifically, 6 times. And in terms of assessing probabilities walking forward in 2023, historically, what does a move from point A, down here, to point B, up here, tell us about what the past actions of some traders, the move from A to B, what might that tell us about the future actions of other traders? 1 year later, 100% of the cases higher, almost a 17% median gain. 2 years later, every single case higher, average gain, just a hair under 31%. 3 years, every single historical case higher, median gain 48%. And since we're talking about the possibility of a secular bull market, which speaks to a very long-term trend, median gain 10 years later, 181%, average gain 171%. Every single case, at least 100% higher. Typically, when we see a move from point A to point B, good things tend to follow over the next 1 to 10 years. And if you examine this table a little bit more closely, this number here, just a hair under 10%. This number here, just a hair under 3%. 2 years out, 5% and 5%. Here, 3 years out, 0.4%. Telling us we should have realistic expectations about how markets operate in the real world. Also telling us if we see an outcome similar to this, or this, and we try to get too cute during pullbacks, it's going to be very, very hard to capture a return like this, or this. This is still a very respectable gain 1 year out, but it'll be very, very hard to capture if we overreact to 100% normal and to be expected volatility that occurs within the context of an existing and what looks like still sustainable uptrend. These numbers down here are impressive, but from a risk-reward perspective and a portfolio management perspective, it's really these cases that we should focus on. If something like this happens, or this, or this, or this, If you're a trend follower, that should be fairly easy to manage. It's not going to be the case here, here, and here over the next 1 to 2 years. Still a positive trend, but much more difficult to navigate between point A and point B to capture that type of return. Another indicator, momentum indicator, that we've covered many times in these videos, the True Strength Index, affectionately known as TSI down here. When we do these studies, we're modeling what just happened in the present day. Looking backwards, we had a bullish cross here that was in force down here, lower right-hand corner of your screen, for 6 months or more. Then we had a bearish cross in 2022 that was in force for 6 months or more, followed by a bullish cross. And it's important, all three of those steps, bull cross in place for 6 months, bear cross in place for 6 months or more, bull cross, all three of them occurred above the zero line, which speaks to the strength of the trend. So right off the bat, it tells you it really doesn't look anything like the devastating bear market in 1973-74. Really doesn't look anything like the dot-com bust bear market with momentum way below zero. Really doesn't look anything like the second half of 2008 into Q1 of 2009, where momentum is significantly worse than what we've seen in the rearview mirror. Going back to 1950, we wanted to know how many times has it happened? Answer, only 14. And what do the past actions historically of some traders, and those actions created this bull cross here that recently occurred above zero, what do those past actions potentially tell us about the future actions of other traders? 1 year out, 93% of the cases higher. 3 years out, 93%. 5 years out, 92%. And if we're talking secular trends, does this type of figure or this type of figure align with or contradict the secular trend thesis? Median gains 1, 3, and 5 years out, just a hair under 16%, a hair under 34%, and a hair over 61%. A number like this, a red number like this, and a red number like this tells us it's not prudent at any point to throw all caution to the wind. To the contrary, you should wake up every day with a skeptical eye relative to the base case. So in the first study, very consistent returns looking out 1 to 2 years. In the second study, based on something that just happened in 2023, very favorable results and consistent results looking out 1 year, 2 years, 3 years, and very satisfying returns looking out 10 years, every single case higher. In the third study, if we just look at the consistency of the green in this table relative to the scarcity of the red, and then we focus on a number like 140% historically, a median gain of 147% looking out 10 years, with every single case higher. Once again, does that seem to align with or contradict the information that we presented back on June 16th, which speaks to the possibility that we're in a secular trend, a secular bull market, primarily driven by demographics, that could last until 2034 or 2035, with 100% normal and to be expected hiccups, corrections, and painful givebacks along the way? Probably fair to say a number like this looks a lot like this and this. And maybe the most relevant takeaway about this signal, if we put these 14 signal dates on this chart, where do they show up? All 14 cases, batting 1,000, every single one of them without fail, occurred within the context of a secular bull market. 1954, 1958, 1961, 1963, 1967, 1982, 1985, 1987, 1989, 1991, 1995, and 1998. The most recent signals, 2016, 2019, and 2023. All the new signals occurring after the secular bull market started by clearing these highs here in 2013. None of it predicts anything. It simply speaks to the probability of good things happening relative to the probability of bad things happening from a very long-term perspective. It says very little about the next 3 hours, next 3 weeks, or even next 3 months. So this analysis, as you might remember, had nothing to do with demographics. And you may remember in that video, using some simple calculations, we estimated that the present day here looks similar to this point in here. And you may remember that was January of 1989. One of the signals that we just registered occurred in February of 1989. How did the stock market perform walking forward? 1 year later, it was up 14.9%. 3 years later, it was up 43%. 5 years later, it was up 61%. 10 years later, up 328%. Once again, not predicting anything. The same date window that we derived in mid-June is showing up in a new signal table. This signal date and the date that we estimated back on June 16th, they're only about 6 to 7 weeks apart. One was in early January. The signal came in late February. And then recently, we did a totally separate analysis using demographics on July 21st, and this chart was presented in that July 21 video. Once again, it's fair to ask and answer. Something that just happened, step A, step B, and step C, all observable. This has nothing to do with worrying about what might happen. It's interpreting what's already happened. This is a fact. If we take the historical signals and put it on the demographic chart, do they seem to align with or contradict the secular trend thesis primarily driven by U.S. demographics? Since older demographic data is a little bit sketchier relative to newer economic data, you may remember we only started this analysis in 1964. But the signal dates out of these 14 that show up between 1964 and 2023, every single one of them within the context of a secular trend. Every single one of them within the context of the 2 green boxes that we covered and drew based on demographics relative to stock market history. This signal is simply another piece in the weight of the evidence puzzle. Seeking Alpha post dated August 3rd. You can find it by Googling the title on your screen. This post also appears on Short Takes. The point of this paragraph, the S&P 500 moved a long way between May 30th and August 1st. Still a constructive look from a trend perspective, but undoubtedly in the short term is not nearly as favorable up here relative to down here. Thus, some type of give back or correction would be healthy at this point. It would bring in new buyers down here, but that's all hypothetical. A lot of good information in this post that we're not going to cover in this week's video. The exact same post with the exact same charts is available on Short Takes with no paywall, nor any type of login or password requirement. Tweet July 31st, 8:43 p.m. On July 31st, the NYSE Composite was up almost 0.4%. You'll notice in the tweet, an emphasis was placed on the intermediate to long-term perspective. It purposely didn't say anything about the short term, because the shorter term charts did look ripe for some type of pullback or at least sideways movement. Doesn't change the look of this chart in any shape, form, or fashion. In fact, if we zoom in on this chart and add some additional anchored volume weighted average price lines as reference points, this is the exact same chart dated August 2nd. The fact that price is above all of the colored anchored volume weighted average price lines tells us that buyers are firmly in control of this market. And all of these areas down here represent potential support. We never assume that anything is going to hold. And what we're trying to do here is, which VWAP lines has the market been responding to lately? If we look at the line off the October low, it's been okay, but it didn't really seem to be particularly relevant here. We blew right through it and eventually moved through it here. So this line and this line, highly relevant. And the lows off of that line right here, the blue line, also appear to be somewhat relevant in here. But this is really where the confidence started down here. So all of those lines are reference points. Right here, including right here. What that tells us is a pullback from this high here in the NYSE composite of approximately 3% would take us to this point here, a logical reference point. A 4% pullback would take us to this point here, and that's based on this low here. So these are all natural places for the market to potentially defend the bullish trend. But you'll also note a lot of times we overshoot. We overshoot in here, we overshoot in here. So if we were to overshoot, come back down into this area here, that's an approximate drop from up here of 6%. These are all good short to intermediate term reference points. Where would concerns really increase? A, if we drop below the red line, and B and C, if price gets into this area here, that would start to contradict rather than align with the secular bull thesis. We never assume what's going to happen. We have a base case, and then we manage against that base case. We could come down here, we could come down here, or even all the way down here. And if the market held, it really wouldn't do anything particularly damaging to that base case. Maximum flexibility 100% of the time. The base case right now is if you're a relatively new client, and even in our core portfolios, if we do some reshuffling, these would be areas where we would consider redeploying capital. And it's not just coming back here. There's several things that we would like to see. But in general, the base case is consider buying the pullback. We'll see how it unfolds. It's a daily chart of the S&P 500 dated August 3rd. Bottom of your screen, the Special K indicator created by Martin Pring. You can read about it upper right-hand corner. The chart dates back to 1940, lower left-hand corner. If we come all the way over here, this is 2023, right-hand corner of the screen, and this is what just happened. Had a bearish cross on Special K that was in place for 6 months or longer. And that's followed by a bullish cross that occurs above the zero line. After the markets have moved, it's easy to feel that I've missed the opportunity. If you feel that way, it's noteworthy that Special K has two primary functions. The first, to identify primary trend reversals at a relatively early stage. Doesn't really say anything about the next 3 hours, 3 days, or 3 weeks. The primary trend speaks to several months and several years down the road. After reviewing the data, all three criteria could only be met a dozen times going back to 1940. Subsequent S&P 500 performance definitely skews to the green end of the spectrum. And as we've noted many times in these videos, it's very easy to look at a table that goes out 7 years and say the stock market's always higher 7 years later. The stock market's always higher 10 years later. If you know your market history, you know that is absolutely positively not the case. It is typically higher 7 years later and typically higher 10 years later. The fact that we're getting numbers like this, that the average gain 7 years out is 109%, 10 years out 176%, tells us with the exception of the 1966 case, from a long-term perspective, this was a really valuable signal. And even in this case, 3 years later, you were green, and 7 years later, significantly green. Not nearly as good as some of these other cases. So let's move on from the bowl of cereal and look at something else that just happened. Once again, we're reviewing observable evidence, facts, rather than concerning ourselves with something that may happen or might happen. And this is what just happened. We had a bearish monthly MACD cross that was in force for 6 months or longer, and that was followed by a bullish monthly MACD cross, and everything occurred above the zero line, which speaks to the strength, the sustained strength of the long-term trend. You don't see something like this in 1973-74. You don't see something like this in the dot-com bust bear market, and you don't get a look like this in the financial crisis. It's only happened a handful of times going back to 1940. Median gain 1 year out, 15%. 3 years out, 38%. 5 years out, 61%. 7 years out, 125%. 10 years out, 148%. Now remember, in periods of secular stagnation, including a period of secular stagnation that was covered in this week's post, the S&P 500 basically went nowhere from the peak in the year 2000 until it broke out 13 years later in 2013. So nothing says we're guaranteed tables like this when we do studies. Once again, does the green table align with or contradict the demographics and/or secular trend thesis? It's a monthly chart with fast stochastics. This is rare to be this incredibly oversold in 2022 and then shoot back up relatively quickly to a rare overbought level. The blue line hits fast stochastic. The green line hits fast stochastic. The only other cases going back to 1940 are shown on your screen. Something that extreme has only happened 6 previous times. And once again, good things typically followed. Also noteworthy, if we go back and look at the signal dates on the chart, there's a reason why these arrows are different colors. In the present day, as we already mentioned, we moved very, very rapidly from point A to point B. These cases are similar. We get a sharp reversal in momentum, a sharp reversal. Not the case here. We hit the same oversold level, but this is in 1974. We don't get back to the green line until 1983, so technically it checks the boxes, but it is significantly different from what just happened in 2023. Similar situation in 2011. Same oversold reading, we can tag the same line, but we don't get back to it until 2011. Similar, more similar. And it's noteworthy where the most similar cases occurred. The early stages of a secular trend window after the major low in 1942 get a signal, and then again in 1949, right before this major breakout in 1950. And then 2 of the signals, the very similar signals, occur in the green secular trend window between 1950 and 1968 that we've been talking about for several weeks. On the left side of the green box, basically where the green box starts, in the green box, in the early stages of the secular bull, we get the breakout in 1982. And like the 1942 signal, this is a little bit early, 2 years before the breakout above these highs that occurred in 2013. Thus, it's noteworthy where the signals occurred in stock market and economic and demographic history. It's also relevant where we're not getting signals. We don't have any signals in this area here of long-term secular stagnation. Nothing near this plunge in 1970, nothing near this plunge in 1973-74, nothing near the dot-com bust bear market, and nothing heading into the financial crisis. So this signal seems to be similar to these signals over here. To summarize, from a long-term perspective, we still have a very favorable fundamental backdrop. And from a long-term perspective, we also have very favorable technicals in line with the long-term fundamentals. We haven't seen anything yet to change the commentary in this August 2nd post. And when we have this type of backdrop, it's prudent to accept 100% normal and to be expected volatility in an effort to capture what could be very satisfying long-term returns. And if we hope to navigate between a point A and a point B that could be several years down the road, we all know the only way that we can do that effectively is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.